Our professional experience includes overseeing corporate governance practices to ensure compliance with regulatory requirements and best practices. She provides strategic advisory services to clients across diverse industries, including finance, healthcare, technology, and manufacturing. She is a lead team member. She leads teams in conducting comprehensive risk assessments and developing robust risk management frameworks. She collaborates with senior executives to design and implement effective financial strategies that drive business growth and sustainability. She speaks at various events. She has personal attributes, analytical and detail-oriented, with a strong commitment to accuracy and integrity, excellent communicator with the ability to build and maintain relationships with clients and stakeholders. She's a very proactive problem solver with a track record of delivering innovative solutions. She's dedicated to continuous professional development and staying abreast of industry trends and best practices. Please welcome with me as we hand over the session to her, Mrs. Ibukun Bicroft. Thank you.
All right, thank you, and good afternoon, everyone.
Good afternoon, ma'am.
Yeah, and thank you for the introduction. I'm happy to be here. Thank you for that profile reading. I was asking myself, are you reading about me? All right, thank you. It's a great privilege to be here and also to contribute to that great institute that is the bedrock of where I am today. I started with the ATSWA, that's the Accounting Technician Scheme, before I went to my university, and also had my professional exams before joining Deloitte. So it is a great honor to be giving back to the society that has also shaped me. So today, also, am I able to share my screen?
Yes. Yeah, closed. Yeah.
All right. You can permit me to go off camera at some point when all right, thank you. So the topic I was given today was to speak about internal control over financial reporting and what the key components are. A lot of us would know that there's this increase from the regulator within the Nigerian environment to start asking questions around how can we trust the numbers behind the financials? How can we rely on the numbers how can we rely on the numbers that we see in our financials? What are the processes that are driving all of these numbers? And that is what has led to what we're going to be speaking to today on internal control over financial reporting. What are the key components? So to address this, is it possible for me not to see people who are entering the room? It's distracting me.
Okay, we'll work on that. Yeah. Okay.
Yes. So the context for today is internal control over financial reporting. We're going to look at the significance and importance of implementing an internal control and how it does enhance overall reporting process. We'll talk about the critical roles and responsibilities of the relevant stakeholders. We'll also look at the consideration for entity-level controls as prescribed by the COSO framework. We'll also look at how can we identify what are the potential financial risks, what are the controls that address it. We'll also look at understanding internal control design and effectiveness over significant processes. We'll look at evaluating operating effectiveness of control and control deficiency. I want to believe I'm in the room with my professional colleagues. So this is something a lot of us would have gone through in the process of being a chartered accountant. But for this session, it's going to be more practical. What we've seen in the work environment is going to be where you can ask questions, maybe what you face within your organization, and also like a continuous learning, like the institute will encourage. So very quickly, they've done introduction of who I am. At the end of this presentation or this technical session, I want to believe everyone in the room will understand why is the need for the internal control over financial reporting implementation. Understand how you can design the control within your organization, understand the roles and responsibilities of the key stakeholders, how you want to review and document what your key processes are or your controls around the financial statement line items using a risk and control metrics, how you're going to leverage the COSO framework in the implementation of internal control over financial reporting during the assessment of entity level controls, and how control designs are evaluated and tested. So to start with is to talk about what's the generation, what led to this? Why is it that Nigeria is just waking up and talking about internal control over financial reporting? A lot of us would have remembered the case about Aaron when there was Aaron era, when there was a major control failure, and several countries now had to enact legislations around how do we evaluate financial reporting controls, which requires management to assess internal control, but not the company's external auditors. Some companies have adopted a comply or explain approach to management assessment, while others have issued a governance code that recommend having a management assessment. What we have in Nigeria, we have from a governance standpoint, where one, for public listed entity, the Security and Exchange Commission has instituted a need for all public listed entities to comply with internal control over financial reporting and report on them. We also have the Financial Reporting Council, which their first year of implementation is this year. So why ICOFA now? You can see that, yes, the United States of America in 2002, after the Enron failure, they enacted the Section 302, 404, and 906, which requires certification of financial statement and other information, as well as assertion on the effectiveness of internal control over financial reporting. That's for the US. You also have the Japanese ICOFA as well. They also put in place, this was established in the Financial Instrument and Exchange Commission for Japan. That's of 2006. They also incorporated the Japanese ICFR requirements. And in applying this law, the Subcommittee on Internal Control came about the need for evaluating and auditing the standards of internal control for financial reports and implementation standard. They have both implementation standard on how to go about it. They also have laws and standards that are collectively referred to as the Japanese ICOFA. Similarly, in China, we also have, similarly in Johannesburg, JSOX and all of that. So a number of countries are becoming aware of the need to have a robust internal control in place that helps to derive the numbers behind the financials that we see. So why the focus on internal control now? One is a commitment to internal control, which permeates across organization. You want to look at what the operations looks like, the operations of the business, how compliant are they with in terms of laws and regulation in financial reporting. While ICOFA is not new, like I said, there is also a lot of complexity around financial reporting and the business model as the world continues to evolve. Beyond just the numbers, now, we have relevant IFRSs that request that we have disclosure requirements. So what are the disclosures that are tied to the numbers? Beyond that, what are the processes that even flow through that inform the kind of disclosures that we're making? Also, the regulators are continuing to push to enhance, one, the reliability of financial reporting for investors. As an investor now, I want to be able to pick the financial statement and make a projection to say, if I want to invest in this company, I'm comfortable that I will have this level of return on investment, or my investment will not go down the drain. And we've seen cases where share price have gone up, and at some point they have nosedive, and you're asking yourself, what are the causes around it? Are there disclosures? So internal control over financial reporting will help the users of the financial statement to gain comfort and assurance around it. So as a result of that, in the past few years, the Security and Exchange Commission, they are now placing more emphasis on the effectiveness of internal control over financial reporting to reduce company failure. That said, SEC has done their own. They will also have, please, if you have your question, you can put your question in the chat box, and we can take it afterwards. That said, that SEC has done that. We also have the Financial Reporting Council of Nigeria, who have also amended Financial Reporting Council of Nigeria. Sorry, please, can you be accepting all the people in the room, or you change the settings so that they can enter the room? It's distracting me.
Okay, I will do that now. Just 1 minute.
Like it's just popping up like I need to clear people in the room. So internal control over financial reporting. One of the things they have, the Financial Reporting Council have done is that they have ensured that, one, there is an act that supports it, which was amended act in 2023. And by the provision of this act, it has amended who qualifies as public listed entities. And we have public listed entities, some are listed and some are non-listed. So for non-listed public entities, a lot of organizations have fall into the category of public listed entity based on the amendments of 2023 by the Financial Reporting Council. So an organization will qualify as a public listed, a public interest entity, PIE, one if they are private companies that are holding companies of a public or regulated entity. So for example, if you have an holding company an holding company that is listed and then has a private entity that is being owned, that is owning the public entity. So those are liable to, they are classified as PIEs. We also have organizations that will say they are concession entities. We also have privatized entities in which government retains an interest. Hello, can you hear me?
Yeah, we can hear you. You can share your screen. Yeah.
Okay. All right. Thank you.
Yeah. Yeah, good.
Yeah. So we also have entities that are engaged by any tier of the government in public work with an annual contract sum of 1 billion and above and settled from public fund. So if I have a small and medium scale enterprise that has contracts with organization based on FRC definition or amendment act, that particular organization, that small SME, must be able to produce a financial statement that confirms that the controls around their process are operating as expected. Then you also have licensees of government and also entities that have an annual turnover of 30 billion naira and above. These are the kind of entities that FRC, based on the Amendment Act, is required to comply. And the first year of implementation for this is 2024, December 2024. So why comply with FRC guideline for public interest entity? One is that, what are the expectations based on section 7, subsection 1 and 2F? One is that management is annually expected to state responsibility for establishing and maintaining an adequate internal control structure and procedures for financial reporting. Also, that management to report on the effectiveness of the company's internal control system in its annual reports, that the independent auditor to opine on the effectiveness of the company's internal control over financial reporting as of the reporting date, that the chief executive officer, that's the CEO and the CFO, they also, or persons who are performing this function in a public interest entity annual report, they will certify. So there's a certification requirement that each officer needs to certify that, yes, the report does not contain any untrue statement of a material fact or omits to state a material fact, which will make the statement misleading in the light of the circumstances under which such statement was made. And lastly, that every public interest entity is required to file on an annual basis is audited financial statement, including a report on management assessment on internal control over financial reporting to the council. That said, it's also good to look at what is the SEC requirement. SEC requirement also is not far from it. And SEC, you can see that from section 60 to 63 of the Investment and Security Act. That was established by the Security and Exchange Commission. Also sets what the requirements are for management in terms of their annual states and to annually state their responsibility for establishing and maintaining adequate internal control. It also sets out what the requirements are for management to report on the effectiveness of internal control. It also sets out requirement for the independent auditor to opine on the effectiveness of the company's internal control over financial reporting or under section 63. Section 60 speaks to the certification overview. If you notice, what there is that correlation or even alignment from what the Security and Exchange Commission expects and that's which the Financial Reporting Council does expect, is that one, the CFO and the CEO or the persons who are performing it, they also file on an annual basis and certify in their financial reports that they are also responsible for establishing and maintaining internal control. They have to state that they have designed their internal control to ensure that, yes, material information relating to the control and its consolidated subsidiary are made known to such officers. Also, that they have evaluated the effectiveness of the company's internal control as of date within 90 days prior to the report, and that they have presented in the report their conclusion about the effectiveness of their internal control based on their evaluation as of date. While section 61 speaks specifically to a public company, that they will establish a system of internal control over financial reporting and security of its assets, and it shall be the responsibility of the board to ensure integrity of the company's financial control and reporting, and also the board of directors of the public company shall report on the effectiveness of the company's internal control system in its annual report. So this means that, yes, the directors are also going to be responsible, especially directors of public interest, public listed entities. They also have their role cut out for them, so that it's not that management is doing their own assessment, but they don't just rubber stamp, they also perform their own role as directors, providing oversight to the management. So why ICOFA, and what is the importance to the overall reporting process? One is that, yes, you have that confidence in the financial statement. Increase investors' confidence. Investors are able to see that, yes, the organization has put together a robust ICOFA process and they are sure that their money is safe. You also show around the accuracy and reliability of the financials that is provided. Also in terms of risk mitigation, excuse me. One of the good thing that that ICOFA would do for an organization is that with this understanding of establishing control, you're able to itemize what are the potential inherent risks that you are faced with from a financial standpoint that accumulates into your financial reporting process. And as organizations go through that process of implementation, they're able to design relevant controls to mitigate this inherent risk, and it allows them to one, avoid financial misstatement, non-compliance issue, and potential reputational damage that may arise from non-compliance. Also, regulatory compliance, based on the requirements of the Security and Exchange Commission and also that of the Financial Reporting Council of Nigeria. Any organization that does not file based on the categorization of their entity, they are liable to a fine, and the regulators are very, very serious about this. They are also going to have independent audits of what management has attest. So if a CFO or CEO should sign off and they come in to do their own testing and they find material deficiency or significant deficiency in the control environment, they might have to answer for it, and it might affect their practice as an accountant. And that's why if as a CEO or CFO, before you sign off your blood, you want to be sure that yes, you are sure that yes, there is an established process around internal control over financial reporting. It is present, they are adequately designed, and they are operating effectively, and that there are no misstatements within the reporting that you're signing off. Also, it helps to improve efficiency. Streamlined financial reporting process are key benefits of ICOFA. You have clear roles and responsibility that are defined, and there are defined approval procedures that can lead to a more efficient process within the finance department. One of the things we look out for based on experience and practice is how is the organization saying that based on the standard operating procedures that they have put in place, they have followed through that process. You know, it's one thing to have a standard operating procedure or your policy documents that dictate how processes should operate. Another thing is, are this process being followed? How do I, as an auditor, verify to say that these things are being followed? I want to be able to see a timestamp or a date stamp or a sign-off or a proper delegation of authority to confirm that yes, the authorized personnel have signed off on this. Also, do I have the appropriate systems or solutions or applications that help to enhance who has access to what within the business? How do I profile access to system? Who does the posting of journals? Who approve those posting of journals? And do I have manual intervention and all of that? So having a robust internal control system or for you to be able to sign off or establishing one will also help the organization, not just around compliance, but improve efficiency. Because as an organization, when you do your assessment, you are able to see where the gaps are and you can fix the gap, because you do not want to sign off on something that is not currently in place. So moving on is to know who are the stakeholders and what are their roles and responsibilities. So for the purpose of this session, we have business and management. One, the business owns the implementation and ongoing performance of control, and they are accountable for one, notifying and consulting consulting the control team when processes and consulting the control team when processes or controls do change. What do I mean by that? So for a matured environment, you will ordinarily expect that the process owners will notify maybe internal control or internal audit, depending on the structure of the organization, of changes that they have within their process, so that they will update their control self-assessments, or maybe their risk register or their control and risk and control matrix, so that by the time they are testing, they are going to be testing based on the current changes that also occur within the organization. Also, from a business and management standpoint, you expect that they will be participating and also reviewing and authorizing processes, and they retain accountability for the control design. I want us to take note of the word retain accountability for the control design. What is not documented is not done. So for every control that you will say is in place, I want to see that there is an evidence that that control is being done. I could see through like an email or a documentation filed away or scanned in a folder where it is accessed or is passworded. So retaining accountability of the control design is also very key in the process of implementing ICOFA. So what is the role of the CEO and the CFO? I already highlighted that earlier in the presentation. I wouldn't want to say that again because I know we have a short time. I will still have a long way to go. Who are control owners? One, they own the definition of the control under their accountability. They are also responsible for overseeing the effective performance of control. They also ensure control performance are appropriately trained and have the required competencies to effectively perform controls. Control performance, they are responsible for the performance of controls. These are the people who perform the activities. And then the last one is responsible for communication. They are responsible for communicating any issues or non-performance to control owners. Please, can you hear me?
Yes.
Okay.
We can hear you.
Okay, all right. So now it's also good to know the other stakeholders. What's the difference between your internal and external audits? As part of one of the things I explained earlier, you have your management team who are doing an assessment or also certifying the financials. You also have the external auditor. Your ask will now be, why do we have duplicated roles? One, the internal control team. They have been appointed by and solely responsible to senior management within the organization. Oftentimes, they are employees of the company. They also help management to review and internally assess the internal control over financial reporting. They may comprise of internal resources or external consultants. We have a number of organizations that do not have the resources, and what they just do is to have like a loan source arrangement or a co-source arrangement with consultants to help them perform this, or an organization can fully outsource that process where they have a trusted consultant for an organization and they are now responsible for advising management on how to manage the company's risk and the goals they have set. They also execute the testing of internal control over financial reporting. They help with facilitating design discussion and assisting management in defining their processes and controls. They also provide training and coaching to management over internal control practices, expectation, documentation, and evidence requirement. For the external auditors, we know what their role is. One is that they've been appointed by the board audit committee and they are responsible to the shareholders. The external auditors, they are independent of management. So whatever opinion they're going to provide on internal control is independent of management, or they can choose to independently do their control testing or assessment, or they place a reliance on management performance depending on who performed those reviews for them. Also, they audit the financial statements and the internal controls over financial reporting. One of the things they're expected to do is to issue two separate opinions regarding, one, the financial statement of the company, and two, the internal control over financial reporting. And they are expected to provide reasonable assurance that, yes, the financial statements are presented fairly, they are in compliance with applicable accounting standards, and that they reflect true representation of the company's financial position and results of operation. They also lend credibility to the financial statements and reduces information risk. So in terms of the key stakeholders, you have the internal control team, you have the external audit, you have management team. All of this all together, we have why am I involved in my control responsibility? One is for transparency, proper communication, documentation, execution. The importance is to achieve a compliance result at the end of the financial year. And also the expectation is that everyone knows and understands what their responsibility are within the space. So moving on very quickly is, so what are the key components that we're going to be looking at for internal control over financial reporting? The first thing is, how do we if I want to assess an organization's internal control over financial reporting, how do I start from? Where do I start from? The first thing is understanding what is the scoping of the financial statement line item, and also what materiality assessment do I need to do? So if I want to do materiality, am I going to look at the profit before tax for my materiality, or am I going to consider just an asset base for me to determine my materiality, depending on what the organization will want to look at? Because you want to be sure that the relevant financial statement line items, they have been scoped, and that you have this, like the code puts it, the financial said significant accounts. So that's what I mean by financial statement line items, for you to scope them appropriately within your reporting or the testing that you will do to give comfort on ICOFA. You're also going to look at what are the entity level controls assessment. And to look at entity level control assessment, you're going to be looking at the COSO framework and the COBIT framework. These are the frameworks that the SEC recommended, and also Financial Reporting Council, and other applicable framework that you deem fit that are suitable for you. But for them to have mentioned COSO and COBIT, they are highly recognized frameworks that can be used. You also will require to have a documentation around what your risks and control metrics are, and then you want to then do a test of control design and operating effectiveness. To do this, I will quickly dive into what is the COSO framework. Based on the COSO cube, I know a lot of us are very familiar with this, so I won't waste a lot of time around it. The key things for financial reporting control is we're looking at the operations, we're looking at reporting and compliance with regulation, reporting around your financials, and the operations on how you carry out your day-to-day operations. What are the things? The bedrock of it is, one, you want to look at it from the control environment, the risk assessment, the control activities of the organization, the information and communication and monitoring. And not just that, you now look at it based on the entity levels within the organization. At the entity level, which is where there is the tone at the top, then you now have different divisions within the organization. You then have operational units and you have the function. So it is quite holistic. And that's why the COSO framework is recommended. And looking at the COSO framework, there are 5 components, which are the ones I just read out, and 17 principles that you want to really test and report on, to be sure that, one, they are present, not just present, they are functioning, and that they are operating together in an integrated manner to have an effective system of internal control. So they have to be present, they have to be functioning, they have to operate together, not in silos, because if they are in silos, it will be difficult to bring them together to have an effective internal control system. That said, it's important to start looking at what are the key components and what are the principles that you are looking at. For the 17 principles, under the control environment, you want to be able to establish that, yes, one, the organization demonstrates commitment to integrity and ethical values. So, and how would you assess that? You're going to be looking at the governance document that they have, their code of conduct, their code of ethics. Is it available? Do you have in place? Do they have standard operating procedures for their policies? Are there policies for each of the departments? Are these policies, are they communicated? Has it been made known to the employees within the organization? For example, around the code of ethics and the code of conduct, is there a portal where these things are kept and you can actually test that they do exist and that they are operating properly? You also want to see how management do exercise oversight responsibility. You want to be sure that for oversight responsibility, you're looking at the board activities for such entities. Do they have the right composition of board? Do they have their board charters and their responsibilities? Are they appropriately documented and defined? The other one is to look at the structure in place in terms of authority and responsibility. You want to be sure that, yes, that organization has a clear delegation of authority in place that defines what level, approval level in terms of signing off of financials. You also want to look at how the organization demonstrate commitment to competency, and that speaks largely to the people policy within the organization. That's the HR policy. You want to look at the process around recruiting or hiring process to be sure that the people who are occupying roles or strategic roles within the organization, they are competent, they have the experience, and they can do the job. The other one is around enforcing accountability. You want to be sure that they have a process for reporting and recording all of the information. So for risk assessment as well, you want to be sure that, yes, they have like a risk management function or department where they understand what is the overall strategic of the organization. They have defined their risk management framework. They have defined what the risk appetite of the organization is, and they now identify how they can identify and analyze risk. They also have a framework around fraud risk assessment so that at every point in time, they have adequate controls to mitigate potential fraud risk areas. They also identify and analyze significant changes within the business, and that's the expectation for a risk management function. Also, looking at the control activities, some of the principles that you want to test is we want to show that, yes, there is a structure in place for selecting and also developing control activities for risk that has been identified as inherent to the business. You also want to establish that there is a process that looks at general IT controls. That's a technology control, because we are in a technology-driven world. You want to be sure that they have appropriate IT policies, they have appropriate segregation of duties, the general IT controls and governance controls that are in place. I also want to look at the process of deploying controls within the organization. Do they have like an intranet whereby the employees can assess and review what the policy is and know what to do when they want to carry out their work? The other one is information and communication. You want to be sure that there are relevant information, they are communicated both internally and externally. For example, you want to look at the investors' relation, their expectations around disclosures for public listed entities, and also for private entities. They also have something around the investors' relations where they disclose relevant information for their stakeholders. And the last one is the monitoring activities. And that's where you have either the control function or the internal audit function within the organization, where they conduct ongoing or separate evaluation around the control environment and also evaluate, and then they have a process for communicating deficiencies. Even those deficiencies, they have a tailored follow-up process to ensure control deficiencies are cleared out and reported back to the management. Like I said, all the 5 components for you to for the external auditors to opine on the financial statement, or to say that the internal control system of internal control is effective. All these five components of internal control and all of the 17 principles must. The regulator or the regulation was very particular by using the word must be present and functioning. So it's not like they do not exist. There is no fast way around it. And the underlying documentation must support management in making decisions in terms of their conclusion. Having said that, I was talking about risk. One of the things the Financial Reporting Council and also SEC emphasize in the code is that, one, you want to look at key financial controls. So that's one thing you want to be sure of. But also you don't want to neglect what are not key controls. So it's important to know what are controls, what are key controls, and what are not key controls. So what I want to explain here is around what a key control is. A key control is defined as a primary control that mitigates the risk of material errors or failure of critical businesses and process objective. And that's why my materiality assessment, my scoping of my financial statement line item is going to help me to determine what are those key controls. Also, a control is defined as a non-key if it is a secondary or a supporting control and does not impact the critical points of control failure, which could lead to a material error or process objective failure to occur without prevention or timely detection. So characteristics of key controls, it addresses high-risk area. For example, you have revenue, you have inventory, depending on the industry. You have for banks, and for banks now, you're looking at interest, you're looking at commissions. These are high-risk area. You're looking at PPE, property, plant, and equipment. You're also looking at your taxes and all of that. Those are key high-risk areas that you want to pay attention to. You want to look at the payroll. You want to look at so many things. So these are things that you want to look at. What are those things that are substantial in the financial statement? These risks might be related to fraud, errors, or non-compliance with accounting standard. Those are high areas of risk. So like all of the new IFRS, in terms of it, you want to be sure that, yes, those relevant IFRS disclosure requirements, they are taken into consideration when you're assessing internal control over financial reporting. Also, you want to look at the significant impact on the control framework. If a key control fails, it is likely to have a domino effect. And what it means is this: it can weaken other controls or potentially lead to undetected financial misstatements. Also, a key control is also categorized as something with limited redundancy. Key controls are often unique and irreplaceable. There might not be other compensating controls in place to achieve the level of mitigation for a targeted risk. Also, there is this focus on prevention and early detection, especially for those key controls. So, example of some of those key controls, you have automated revenue recognition system with strong data validation controls and regular reconciliation. That's an example of a key control. So if you use SAP, for example, now, that SAP application, SAP application is a key application that has to be reviewed, looking at what, using the relevant COBE framework to look at who has access to what, who can make changes on the system. If there are changes, what are the protocols around it? So for non-key controls, you're looking at, okay, they address lower risk areas. It's a supportive role. They focus on detection or monitoring. They probably redundancy or substitute do exist, meaning that they are compensating controls for those kind of controls. For example, non-key controls might include expense report approval or IT assets controls for non-financial systems. You know, apart from your financial system, you have non-financial system. So you want to look at it to say, oh, what's the impact of the non-financial system in the overall financial system? So this might not be non-key control. But having said that, it doesn't mean that you will neglect non-key financial controls, because a cumulative failure of non-key financial control might mean that a key control might fail. So it's also important to take a note of them and not just close our eyes to it when we're looking at key controls. So what are types of control? I'm going to skip this because I expect that we have professionals in the room who understand what this type of controls are. We have preventative controls, corrective controls, detective controls, and directive controls. What are the key components in defining a control? One, you want to look at the control performance, the evidence, the frequency of the control, and how that control is being reviewed. So looking at the control performance, one, you want to be sure that, yes, you have a dedicated individual or a resource person who is responsible for that control. You want to align that control to specific tasks or responsibility of individuals. You want to have like an is augmented by a comprehensive understanding of the business process, like someone who handles PPE, that's fixed assets. The person understand the process around acquisition, recording in the register and updating, even disposal, also disposal of those assets. So you want to be sure what are the associated risks with that. Similarly, you want to also consider what defines a control, like the control evidence. What kind of evidence do I need to keep? One, compliance requires evidence that supports the control activities. Some are data and information, so such as, okay, data and information to establish observation and to also support opinions and conclusion. You want to be sure that there are appropriate documentation in place. I said that earlier. You want to also know, like, what are the type of evidence you want to observe. Is it that you observe the evidence, or you're taking a screenshot, or you're doing a reperformance of the control for you to establish that that control it happens for a stock, verifying that the stock do exist. You want to probably carry out a stock count to validate what the stock counts they have, or review the stock counts report, or confirm that they have like a stock count depending on the industry. If using an inventory, using a manufacturing company, for example, then you want to be sure that this they have evidence that's documented against each control they have identified within the respective risk and control matrix will help to serve as a guide. The frequency of control for ascertaining the that internal control over financial reporting do exist. It's also important to know the frequency of the controls. Some controls are daily, some controls are weekly, some are monthly, some are biannual, some are annual. So the frequency of those controls will also help to determine how you want to test the controls. So, and if as a consultant or even your external auditor, they're going to use a particular framework in selecting the samples to test, they might not be able to do 100% for control, establishing that they are present, they are functioning, and they are operating effectively. That is different from their substantive testing. Their substantive testing is majorly on the numbers, that they can actually see how you arrive at the numbers, but not neglecting the controls environment. So while they are doing their substantive audits, they are also checking the control environment. And some of the things they do is to ensure that, yes, there's a defined and established process around it, which is commensurate to the level of risk. The frequency of the control operation will be sufficient to provide reasonable assurance that the risks are appropriately managed, and also management should ensure control frequency is adequately derived. And lastly, around the control review, for you to be able to establish that, yes, there is appropriate control review, you want to be sure that there is an independent review, approval, or authorization of tasks and activities that are defined within a control activity. You want to see sign-off, desktop review, and review meetings where they have discussions. So for example, like when you're presenting your budget for an organization, there is usually a process for budgeting. It goes through different levels of approval. They have a budget meeting and then the sign off. Where will you see the sign off? You probably see that from the minute of meeting, establishing that this budget was signed and this was the amount. So those are evidences of a control that was being reviewed. Due to the nature of the control, you may also do like a performance, which may require as a review of the control activities. So management should ensure that training and individuals trainings are performed, and that individuals are aware of their responsibility in terms of control review. How then do we identify the reporting risks and the controls that address it? I spoke about scoping and risk assessment overview. At the very high level, it's important to consider both quantitative and qualitative processes. For the ICOFA exercise, you want to consider both. One, how material is the account or line item or the transaction related to the process. The qualitative one is the volume of the transaction. You want to look at the complexity of the transaction. You want to look at the extent of judgment. And for example, now it's going to be evaluation of a project or evaluation of a stock, like maybe cement, for example. I may not be an expertise in that. That means I may have to rely on an expert report that has been done for me to arrive at a decision around that. You want to look at what is the history of error or fraud within the organization, and other things that you may consider. All material balances on performance or planning materiality, they have processes that are included in them, and they come in material, but high risk area may also be included. One, you want to look at the materiality, and you also want to look at the qualitative factor. So the materiality will help you with the numbers, but the qualitative factors will help you to ensure that you have not left out anything. So if, for example, a particular process is prone to fraud, but and that there have been fraud instances or internal audit report of theft or failure, you may want to factor it in, even if it's below your materiality level. So that will give you the processes that are in scope. Then you do risk profiling based on the quantitative factors, and then you have the high, medium, and low. You categorize them. Most times when you want to do your testing, you focus your testing on the high and medium, low. So what are the things you want to consider for the qualitative and quantitative and qualitative assessment? Based on the PCAOB or AS 2201, they have identified as like an integrated audit of financial statement. And some of the risk factors that are considered is the size and composition of accounts, the susceptibility of it to misstatement due to errors of fraud, the volume of activity, the complexity, the homogeneity of the individual transaction processed through an account or reflected in the disclosure, the nature of the account of the disclosure, the accounting and reporting complexity associated with the account or disclosure, exposure to losses in the account, possibility of significant contingent liabilities arising from the activities reflected in the account or disclosure, existence of related party transaction in the account, and changes from prior period in the account or disclosure characteristics. So this is like high level analysis if you want to do your materiality, but I won't delve into that. The other thing is, for financial statement, there are certain assertions that we're looking at. What are these assertions? Some of the assertions that I've highlighted here, you want to, for some of the financial statement line items, there are certain assertions that you want to confirm that you want to test for to be sure that yes, controls in place addresses those assertions. One is the existence or occurrence. You want to be sure that transactions and balances that are included in the statement exist and that they have occurred. Completeness, all transactions and balances that should be included, they are present. Rights and obligation, the company has the rights to the assets and liabilities that they have reported. Valuation and allocation, you want to be sure that yes, the assets and liability are accurately valued and are allocated to the correct period. Presentation and disclosure, that the assertion states the components of the financial statement are present in the appropriate locations and that the financial statement include all necessary disclosures. Accuracy, that this refers to that, okay, the degree to which the financial statement or the report currently reflect the true financial position, performance, and cash flow of an entity. Cut-off, you want to be sure that revenue, or for example, is recognized within the period and that expenses are recorded in the correct accounting period. For example, you look at when you're looking at your accruals or prepayments, there's usually you need to check the cutoff for the recording and if it's within the appropriate period. How do you then analyze the risk factors? I've mentioned that the risk factors are the complexity of the transaction, the volume of the transaction, management incentives, and this is very common. You want to be sure that yes, there are no pressure for management to actually meet some financial targets, which might incentivize manipulation. So if you are checking the system or you're a control person, you want to look at what is the tone at the top. You also want to look at the accounting system weaknesses. How robust is the application for financial reporting? Are there adequate controls around the data entry, the authorization, the reconciliation within the system? Also, the use of estimates. If organization use estimates, you want to be sure that, yes, they are practically use a scientific approach to arrive at those estimates, not just or they have used a professional to arrive at those estimates, especially around inventory valuation, especially some certain type of inventory, or even bad debt provisioning, if they have a policy around at what point a bad debt is being provided for according to their policies. All of these helps to ensure that you have strong controls to ensure the accuracy of the financial statement. How then do you identify the financial statement risk? One, you want to leverage tools and technology. You want to do like a risk assessment. You want to have like analytical procedures. You also want to have an inquiry mind. You want to be sure that you focus on materiality and both quantitative and non-quantitative areas should be considered. Then the other thing is, how do I know that a particular controls do exist? You want to establish that, yes, you have someone who performs this activity, what the activities are performed, what kind of forms or reports are being generated, where the activities are performed, when the activity is performed, the sequence, the timing of those activities, why the activities are performed, and why the activities are performed, what are the controls that they are trying to mitigate or control, and then how did it happen, how did the event take place? For example, how was the document review? Was it by email or it was through an hard copy? So controls should be documented and should be taken into consideration using the 5 Ws and 1 H. The process and control owners within each unit should work in conjunction with the internal control to update their control registers. The control registers should be updated and shared to enable easy access at any point in time. It is also the responsibility of the control team to update the control register. And this is how you then evaluate the key controls. You want to be sure, yes, if they mitigate the risk, if it is appropriate within the frequency of time and the appropriate roles and responsibility. So adequacy of a control, you want to be sure that, yes, it prevents fraud and error. You have appropriate mitigation plan for a particular risk that fails if there is an ineffective control, or you want to check what are the compensating processes are. And also the control assessment. That's when you have new controls in place, you then assess it, identify the risks and document the controls. Then if there's a new process, for a new process, you need to document what are the risks and controls that needs to be in place for those new process. So control design adequacy refers to, one, the suitability and the effectiveness of internal controls in mitigating the identified risk. What about testing of effectiveness? How do you do that? One is you want to look at use a variety of tools to perform it, like for disclosure controls and procedures, and ICFR evaluation. Some of the things you want to look at: management daily interaction with control system. You want to perform a walkthrough to understand those controls. You want to interview individuals who are involved in the relevant controls. You either want to observe the process or the procedures, including adherence to what the corporate policies are, or you also do a performance, or you review the documentation that provides evidence that those controls do exist. So a combination of all of these tools should be used for disclosure controls and procedures and ICFR evaluation. Although inquiry and observation alone might not provide you an adequate basis for an evaluation of an individual control with a lower risk, they will not provide an adequate basis for the evaluation as a whole. So you may want to do a performance beyond just inquiry and observation. Then how would you say control is effective? Control effectiveness refers to the extent to which the control is actually functioning and is designed and is achieving the intended objective purposes. You can do based on sample testing, and then you review. What are the effectiveness or documentation expectation? I spoke to that earlier. I wouldn't want to repeat it. So it's also important, and this is a very key and what management needs to know. At what point will I say there is a deficiency in the evaluation, and how do we remediate it? So the first thing before as at Deloitte, one of the things we have done is that how do we approach deficiency evaluation? So for example, now, if I should perform a test, how do I establish that it is a control deficiency? How do I establish that it is a material deficiency? And how do I establish that it is a significant deficiency? If it is a control deficiency, who do I report to? I'm going to report to management. If it is a material deficiency, I'm going to have to report to audit committee. If it is a significant deficiency, it must be included in the reports to the public. So this is a detailed process that we have put together as an organization to arrive at this conclusion in terms of level of deficiency. You want to be sure you have gathered all your facts, you have considered what the potential misstatements are, If there are compensating controls, you want to review those compensating controls. If no compensating controls, then you arrive at your conclusion. What happens if a control should fail? One, controls could fail as a result of one, poor judgment in decision-making, human error, or control processes being deliberately circumvented by employees or others, or management overriding controls, the occurrence of unforeseen circumstances. And when there's a control failure, it could result in fraud, exposure to confidential information, as well as financial losses. There should be compensating controls in place to detect fraud and financial misstatement. This will reduce the risk of financial loss. And what are the actions when you have a control failure? One is to know what is the root cause of this failure. You want to select and implement what corrective actions to mitigate it. And you also want to monitor the corrective action. You want to be sure that these things are operating effectively. So the Financial Reporting Council requires that management of public interest entities to present in the report their conclusion about the effectiveness of their internal control based on the evaluation as of that date. Also, the section requires management and independent auditor to disclose to the public in their public report only material weaknesses that exist as at the year-end assessment date. So only material misstatements that are being disclosed to the public. So organization will have to ensure that, yes, they don't get to the extent that there are material misstatements on internal control. That will be a disclosure, and it might impact investors' decisions in the near future. I don't know if we have time. I'm happy to take questions. I'm happy to take your questions now.
Okay. Thank you so much, Mrs. Ibukun Bicroft, FCA. So question time. Mr. Oshunan, how do we go about it? How many should we?
Okay. Thank you, my chairman. This is the general secretary. I'll stand in for him. He's on the road. So thank you very much. I'll call you erudite scholar who done justice to this topic, and we want to appreciate you on behalf of the district. So my distinguished colleagues, if you have any question, can you raise your hand electronically so that we can have, we can actually accommodate maybe 1, 2, or 3 questions max because of our time. So I can see Dr. Bode. Can you unmute and ask your question, sir?
Okay, thank you, Mr. Aishola. Thank you, Ibukun, for the presentation. I think this is qualified for Professor of Practice presentation. All right, well done.
Thank you.
Yeah, I wouldn't expect less anyway.
Thank you.
My question is, my question is, this internal control over financial reporting, can it be performed internally? Can this responsibility be given to internal control, internal audit in an organization? And what will be the strength of such assessment? If any one of us internally conduct this, would there be any value to it at the end of the day? That's my question. Well done.
Thank you. And you've asked a very good question, because this is something that has been of concern to a lot of organizations, considering the state of the economy and the cost implication of it. So I'll answer it in 2 ways. The first is, what is the maturity of the control environment of the organization? That's one. What is the maturity of the assurance functions? The assurance functions now are the risk management function, the internal control function, and the internal audit. How matured are those functions? And from a risk management standpoint, does the risk management function, do they have a comprehensive risk register that takes into consideration key financial risk and non-key financial risk? And have they documented what the controls are and what's the control objective that they are testing and the assertions that are being tested for financial statement? If that exists in the organization, one, the internal control can take it on as part of their routine monitoring, because, I mentioned something around the frequency of those process. So based on the frequency of this process, they want to test. And when they are testing, they document their testing so that they will keep it for their external auditors to perform a review at year end. Then you also have another level, depending on the way the organization is structured. We have instances where the internal control and the internal control, even risk and internal audits are put under one umbrella, but that's not best practice. But where you have an independent internal audit function, the internal audit function, because they do report and provide assurance, not just to the board and also to management, because they will want an independent eye to look at what the control persons have done, so that the CEO and the CFO, they'll be happy to sign their blood, and even the board will gain assurance to say that this is done appropriately, and they can now do a performance of those tests, provided they have gone through the process where I spoke about scoping and materiality. If they have gone through the process of identifying what the qualitative or quantitative procedures are, or if they have those knowledgeable understanding. If all of this exists, the organization can engage and do it by themselves. But if they do not exist, I will advise that, one, you consider having an independent consultant to help you put together a framework for your ICOFA reporting purpose, because one of the things I've seen is it gives your external auditors that level of comfort or reliance, or you consider a lone staff from an experienced consulting firm who will help you to set up that process. And one of the things you want to establish, you want to provide training, awareness for people like this session that you've had, and then they can have a practical session where they will do it the first year for you, and then the control or the assurance function can take it on going forward. I hope I've done justice to your question.
Okay, thank you very much, ma. From the chat box, Lola Moruf asked, say for attestation of financial reporting for a client, what can we do not to sign a misleading financial report? Okay, I think he's asking, what can we do so that we don't sign a misleading financial reporting in view of this ICFR?
So, okay. If you are an external auditor and you want to do an attestation, you have to do a reperformance of what has been done. One of the things that should give you comfort as the external auditor to do an attestation is, one, you need to ask for management documentation around their internal control framework. You want to see that they have a risk and control matrix that includes all the financials, line items, assertion, and the control objective. And you then either do your independent testing of those things that they have selected, your samples, or a reperformance testing, meaning that the samples management have tested, you have also tested it. If peradventure you do a testing and those controls, they failed, you then want to check, are there compensating controls? If those compensating controls are not there, and depending on the level of severity, based on what I've said, is it a control deficiency? Is it a material deficiency? Is it a significant deficiency? Then you'll be able to state in your financial statements the level of deficiency, and that will guide you as an auditor not to just attest on the financial statements if you are not comfortable with the control environment. So if they don't have an established control function, they don't have an established risk management function, they don't have a risk appetite or a framework, at the entity level testing, they have already failed, because that is what sets the tone at the top. Also, you have you have the entity level controls that you need to test. And if there are no policies or procedures already, that alone puts you on inquiry. Your professional skepticism is to come into play. Yeah. And you don't want to sign a financial statement that you cannot comfortable about the control environment. Even notice even external auditors, when they're signing, to save their head, they'll tell you key matters that they need to bring to the board for consideration. Key matters arising, even when they sign their opinion. It shows that there are some judgments, there are some consideration they have taken into place before even signing. So it might mean that you are qualifying the report because you have not gained the right level of comfort and confidence in what management has done. So you don't just attest all because of attesting. And the risk of attesting when you are not comfortable is that you should FRC or FRC or the Security and Exchange Commission, depending on the entity, that the categorization of the entity, perform a review, an independent audit, and they find a failure. Yourself, the auditor who signed off, the CEO and the CFO who gave a clean report, they will have answers. They will have questions to answer from the regulators. And it might be something you don't want to get yourself into. Thank you.
It requires some very good tact on the part of professional. So we'll take Aliu Kamiyo, and that will be our last question for the day. Can you unmute and ask your question?
All right.
Aliu.
Thank you so much for the wonderful presentation. My question is going to be to one. The first question is, it has been among the group of people looking at it and see that the control effectiveness that is being tested by assurance consult, like auditor in prior years, and people are saying in that how is it different from this performance of the ICFR testing? Is it like since the adventure of ICFR now, we notice that a large part of the auditors, that aspect of control effectiveness had not been handled anymore. So it's a bit kind of like clarification, like does that the ICFR testing actually now replaced the initial control effectiveness from the auditor? That's the first question. The second question is, when you're documenting your control, is it going to be like a casting stone that all your risk documentation must have an adequate financial assertion? Being in a situation where we look at some risk, and then in terms of their materiality, they don't have a big implication on your financial statement, and you still see where your auditors also naming this as more like a design deficiency. So can you just clarify a bit about that? Thank you.
Okay, thanks. Very good and practical question you've asked there. The first one is, what is a clarification, like you said. What is different from what the external auditors have been doing around the control effectiveness testing that they have been looking at, or for prior year? I think what is different now is we want a documentary evidence. Do you understand? You also want to be sure that there is a framework, there is a detailed approach or procedure around it. To be honest, the external auditor will already have it in sections based on their planning on testing of the control effectiveness. That section is there. But now, beyond that, it is now an additional requirement that they on their own, they attest to it. So that means if they did a walkthrough of a particular sample to look at control effectiveness, they probably might be fine. But now they're not doing just that. They're going to have a tailored approach in the selecting of their samples to ensure that the control is present, is functioning, and is functioning all through the year. So that means they either do their own independent testing or they do a performance testing of what management have put in place. So it requires an additional and a painstaking review in addition to the control effectiveness review that they're looking at. At some point, some may just focus on maybe the entity level controls, but beyond entity level controls now, they are checking all other financial key statement line items beyond their substantive testing and their methodology for audit. And that's why you will notice I kept emphasizing the materiality for their financial statement, because that threshold, they need to define it and document it. What is not documented is not done. So I hope that clarifies. Then your second question now, I'm trying to remember now. It's, sorry, it just skipped my head. Your second question, if I remember, it's
a financial assertion when I'm
financial
documenting my
assertion.
list.
Yes, thank you. So the financial assertion, there was something I tried to picture in my presentation, is that you're looking at your key financial items. So for your key financial item, each of them will have an assertion that we test. So for example, we want to look at revenue. Revenue, the key assertions your external auditors will be testing. They want to be able to see that from an internal control standpoint, you have been able to establish the controls around your revenue recognition, the cutoff procedure, the completeness of it, and the accuracy, and the systems that generate it. So those are things that you want to check. So the relevant assertions is also good that if it's going to be done internally, you need to have a session with your external auditors. Can we have the assertions you are going to be looking at for each of these line items, so that we are sure that, yes, we have covered all of those, our controls that we have documented. The key is the documentation of the controls. And like I said, how do you want to test that a control documentation is clear? Does it have the 5 Ws and the 1 H? Those are things that you want to consider when you're documenting your control. So it is an extensive documentation.
Thank you very much.
All right, thank you. Thank you very much, madam, and distinguished members and guests. We have delivered again, as usual, the model district. We have been